All right, everyone. As we talk about in the past, you see my posts. I always talk about OneDigital. The OneDigital way is working in teams, and individually, none of us know everything, but collectively, we do know everything. And putting it all together here. So today, one of our practices, and this is one where a lot of people don't, when you talk to them about captive insurance and the captive insurance concept, a lot of people go, I've heard of it, but I don't really know a whole lot about captives. Well, so we're going to learn about captives today, and I have here with me Aaron Lubbers, the head of our captive insurance program practices out of Louisville.
We'll get
And you're out of Louisville?
yes.
Yeah. So yeah, he's out, but being out of Louisville, like I said, we operate nationally. So we have access to, all our different offices across the nation. There is no limitation to what we can do. And like I said, I just want to bring Aaron along and first off, so Aaron, a couple of things. We want to know about you, your past, and then we're also going to talk about the award you got. So give us a real, history as to how you got into captives, and before we even start talking about what a captive is, how did you get into this?
Yeah. So from the brokerage side of it, so I was a little bit unique that I learned captive or I learned alternative risk financing. I'm sorry, I learned insurance through the lens of alternative risk financing. So I started with captives very early in my career. How I learned the insurance business, how I learned accords and just kind of the coverage forms and the rest. Tom was really through the lens of alternative risk financing and through captives. So I've been in this space exclusively for about 12 years, primarily working in a consulting role with other independent agencies and brokers around the US, a little bit into Canada to provide education and guidance, and probably most importantly, options as it relates to what's available for US insureds. So I stopped counting at a couple hundred different captive formations, indoor joinings. It was a few years ago. Um, really wide variety of industry type, really wide variety of coverage type. We've done work in seven international domiciles. We've done work in 6 U.S. states. So again, not a lot we haven't seen or done as it relates to the captive space. We have some clients on the Fortune 500, all the way down to just local regional family firms and joining a group. So like I said, started in this space again about 12 years ago, and that's very specific to property and casualty. I know we with OneDigital the big benefits arm of that. We have a separate team that will handle the benefits or the EB side of this that are excellent at what they do. Outside maybe a true single parent, that's typically where I'll get involved, where it's like if a true large single parent insured standing alone. That's where we can work that like medical stop loss or something else into that coverage area. But traditionally, it's 95, 98% of my work is done in the P&C space.
Yeah, that's interesting you said it because on the captives, you have the property and casualty side, you have the employee benefits side, and this one we're going to key in on the property and casualty side. And when you said you've been in it for 12 years, you're not just the average person, you're just receiving an award. And I saw it on LinkedIn this morning. It's the 40 under 40 from the Captive Review magazine. Just tell us a little bit about winning that award. I mean, that's because that's a worldwide deal. And to be in
It
the top
is.
40 under 40 on a worldwide basis for captives, that's very impressive. Just tell us
Yeah.
real quick, what is Captive Review magazine? What do they rate you on and how do they base it?
Yeah, so they have a team of judges. So Captain Review Magazine is a large publication that gets published specifically around captives to further the advancement and the education of that offering within. It's a global magazine. So um, Tom, it's there's a panel of judges that vote on. I had to meet certain criteria. I had to put out a list. You're voted on by your peers. So I had a lot of peers, peer nominated, which is fantastic. So the peers have to nominate you. There's a list of questions that one has to answer to kind of be considered of it. There's a panel of judges that are from all of the alphabet shops that you would think of, right? So captive managers, regulators, industry producers, reinsurance partners, fronting insurance partners. It's all public knowledge, but there's just a general criteria that has to be met, and I was selected as one of the 40, so 40 under 40, and yes, I still am under 40, which is I know, I'm
Unlike
getting
some of us, right?
I'm getting some jabs on this. but Tom, it's what I think something that's unique is that I also won this award in 2024, and so I was included in the 2024 class of it's Captive International, Captive View Magazine, their class, and I was awarded again in 26. And so I'm actually not allowed. They actually told me after this year, I'm not. I was on it twice. I'm not allowed to do it anymore, which is good. But that is, yeah, it's a humbling honor. I'm grateful for it, incredibly grateful. It's a testament to the team around me and the people that have poured into me personally over the years that I just had the opportunity to learn from. But it's represented by. I was telling you this earlier. There are 14 or 13 countries represented within that 40 under 40. There's the U.S. and Canada. There's several Caribbean domiciles, and then you got to Europe. So looks like Poland and France and Switzerland and India is on there. There's a gentleman from India that's on there. So really is a kind of a global recognition, which I'm incredibly grateful for.
Yeah, that's awesome. Congratulations on that. That's no, it's an honor. And if it's your last one, so what we'll do then for future, we'll find another magazine and we'll just nominate you for that. Right? Yeah. We'll do that.
Yeah, they have another award called the Power 50, which is like the 50 most influential within the space.
Yeah.
I'll kind of keep my eyes on the Power 50 at some point.
Right. There you go.
In due time.
We'll get you on there.
I love it. Thank you. Yeah.
That's awesome. Yeah. So real quick now, going into because like I said in the beginning, a lot of people they don't when you talk to them, they've all heard the term captive insurance, and they hear, oh, a captive, I can be part of like the ownership in an insurance company that insures me, but how does that work? So real briefly, go the basics, like the 101 on captives. Tell us what is a captive, what is it, how's it formed, and just kind of take us through that process.
Yeah, sounds a good question. So something, and I'm gonna pivot just for a second. So I enjoy the teaching side of this. Something that I've always enjoyed is the educating producers, educating brokers, educating insureds around this concept. And so part of that is that I didn't mention this earlier. I joined the faculty for the International Center for Captive Insurance Education. They have a specific ACI designation, a professional designation. It's an associate in captive insurance. It's a 2-year program, dives into everything as it relates to captives. So onshore, offshore. Why do they do it? Talking about the accounting, the financing, the tax treatment, the everything. And so I was able to. It's backed by the University of Vermont, and I joined their faculty in 2025 to help teach one of their ACI courses, or to help teach along with other esteemed colleagues. But this is something that I enjoy to do, and I could stand up here and wax on eloquently for the next hour about any direction you want to take this. But let me focus in on kind of the beginning, which is where we start these conversations a lot. And you hit on something that I actually do when I teach or when we present to various broker partners, especially in like larger rooms or larger settings, and there's kind of an open dialogue. I will ask them to define for me what a captive is. And it's an interesting exercise. You should do it in your office, by the way, and just say, hey, tell me what a captive is. Give me a 2-minute, well, not even 2, but 2-sentence, 3-sentence definition as to what a captive is. And if you ask 10 brokers or 10 people that question, Tom, generally you get about 10 different answers.
Right.
And so we always start these conversations the same way. What's a captive? So a captive, by definition, Tom, is a separate insurance company that a business will create or maybe join as part of a group to insure their own risk. And it's going to do all the things that a typical insurance company does. It's going to collect premiums. It's going to cover certain risk areas. It's going to issue policies and certificates and auto ID cards. Tom, and ultimately it's going to pay claims. So whenever you hear the term captive, what I want you to think about is an insurance company, because that's what it is. It's a licensed, regulated, honest-to-God insurance company, and it's going to operate as such. And that opens us up to all the rules and regulations associated with owning and operating that insurance company. So whenever you hear the word captive, that's what you think about. It's an insurance company, right? And it doesn't matter if we're talking about onshore, offshore, property and casualty, benefits. It doesn't matter. Anytime you hear the word captive, it's an insurance company. And what we have to figure out with our clients, do you want to be in the insurance business? Because ultimately, that's what you're asking. Whether you're in a group, single parent, anything else, do you want to be in the insurance business? And then what does that mean? How does that align with the direction of your organization and where you're headed? And then how do we structure it from there? But regardless of the domicile, ultimately, Tom, it's an insurance company. And we have to understand that first before you can build on structures and coverages and retentions and service providers and all the nuance that goes into it.
Yeah, that's yeah, because like I said, it's owning the insurance company. I tried to explain it so because to me, like I said, I'm not an expert in captives. That's why we, going all the way back to when we became a OneDigital company. We were a local broker here in Chicagoland. Yeah, we have customers that get into the complex risks. They get into where they're paying $500,000, $1 million insurance, and they hardly have any claims. And they say, they look at us, they go, "Are there any other concepts? Are there any other ideas? Because I'm paying $1 million for my insurance, and I had $50,000 of claims. The insurance company's making a ton of money off me. Is there any way that we can structure something to where I can participate or get a dividend or get a refund or whatever it is?" And that's where, so then you try and talk about a captive insurance concept. And when you're not an expert in it, you go, like I said in the beginning, I gave the simple, oh, you become part owner of the insurance company and you participate in the gains and the gains and the losses.
Yeah. Yeah, I don't think you're wrong in that, Tom. Right? I think the idea of this is, look, where can we, as an organization, where can we take on a predictable layer of risk inside of these insurance companies, these captives? What we're trying to do is we're trying to assume the predictable and transfer the catastrophic. We want to be able to participate with the risk, participate with the carrier on that risk. And if we're going to participate in the risk, we want to be able to participate in the reward of that, if there is one. While a captive is a form of self-insurance, let me be clear, this is not let's throw money into a bank account and hope our losses don't outrun those dollars. This is where it's a little different, that we want to be able to take on what's predictable and participate in that. Again, but we want to self-insure with some guardrails as we think about what we want to do here. We don't want unlimited exposure. We don't want unlimited risk. We want to be able to participate in that. And these captive structures, that's what it allows you to do. It allows you to participate in that risk with some security on either side. And this is where these conversations will shift a little bit, especially on the property end of this, which I think is where you were going, is that it very much turns into a risk tolerance discussion, more so than a can we or should we discussion. So it becomes about risk tolerance. It becomes about aligning that structure with what we're trying to do as an organization and what we're ultimately trying to solve. And then there's nuance to that. General liability, workers' compensation, auto, yes, they are the premium drivers. 90% of the time, that's what we're looking at, right? Or some form of that.
Mm-hmm.
Deduct a reimbursement structure or a frontage structure. Property has probably been more in the last, we'll call it 4 years, 5 years, as that market really hardened and capacity tightened up, where we started to look and explore other options. I've had a lot of conversations, Tom, over the years with property owners that are really frustrated and they're kind of stomping around and they're saying, "I'm just going to self-insure. We're not filing claims." You can. You can. You just better hope for the first few years the wind doesn't blow. Because here's what that means when you say you want to self-insure. And then, by the way, do your lenders allow you for that? If you have a flag, like a franchise flag, are they going to allow you to just self-insure?
Right.
What's that mean from a collateral perspective and a capital perspective? We start breaking out the risk tolerance of this. More importantly, we start breaking out like the limits. We start breaking out how this works, just like a blocking and tackling from just a coverage perspective. How does it apply? How do certificates get out? Things like that. Again, just because you're an insurance company doesn't necessarily mean that these captives are unrated insurance companies. So you have to work with service providers, fronting carriers, and reinsurers to be able to stay compliant with franchise requirements or certificate holders or lender needs. So there's a lot to unpack when an organization does that, especially
Right.
by coverage.
Yeah. And when you were talking, you and I were talking last week, and you were saying, someone may be paying, as I mentioned, the dollar amounts, 500,000, 1 million. Well, within there, because the captive, the captives you're talking about is you kind of you're looking at your general liability. So you're going to unbundle that cost structure, right? You're going to look at general liability, workers' compensation, and the auto liability.
Yes.
It's kind of what you're looking at for that captive. And then you mentioned also a property captive. So, you kind of that's a separate situation or program that you put that into, right?
It is. Yeah. And
Yeah.
look, the captive at the end of the day, especially when you start talking about the casualty lines of this, which is the work comp, the general liability, and the auto side of it, captives are a reward for this is a risk management plan. Right? Captives are a reward for organizations that manage risk well and that are committed to doing so over the long term. And so because of that, because we're focusing on risk management first and understanding how the organization is controlling risk within their company and within their operation, um, that's that is more on the casualty side. That's why there's a focus on the casualty end for these. Because those are the premium drivers typically, workers'
Yeah.
comp, general liability, auto. Those are premium drivers within the organization, typically have the most pain points. They also have probably the lowest limits. Workers' comp, not so much, it's statutory. But when you think about an auto limit, it's a $1 million CSL. General liability, it's a 1.2 GL, right, or a 2.4 or 5.5. You can push that up to a 2 million CSL. But they have very defined limit amounts with excess umbrella standing over the top. Shift that idea to property a little bit. Question's going to be, hey, from a risk management side, can you predict or can you risk manage whether a windstorm or hurricane comes through?
Right.
No, you have less. It's less controllable from a risk management end. You can control whether employees leave work the same way they came in. You can control to an extent keeping your employees off of their cell phones and off of people's bumpers. To an extent, you can put out a product that doesn't harm property and people. It's harder to control whether a tornado whips through and knocks a building down, or a fire comes up and causes substantial property damage. Right? Of course, there are best practices, but then the other side of that is we also start thinking about the limits. Hey, I'm spending $1 million. You're getting $100 million worth of capacity.
Mhm.
What's that rate? How does that break out? And where do you want to take risk? The question is, do you want to go from 100 million to 50 million in cover? Well, no, of course not. So then we say, all right, at what point do we start taking risk? And that's where size determines the options on the property side, especially. Because what we've seen is that you have organizations that are starting to take layers of risk, tranches within their tower, and just using it as a funding mechanism, which is great. But you're seeing that with really, really large insurers. A lot of our publicly traded companies are starting to do that, where they're participating in layers of risk within their larger tower. On the property and casualty side, though, it really is just it really starts with kind of the math equation, because the limit isn't not necessarily that big of a deal because you can kind of get to the limit. But this is where we start thinking about how do we evaluate just like sincerely, it starts with the math equation, which is how much premium are we paying versus what does our loss experience tell us versus how much money are we getting back to fund that experience, and is it worth it? So it really does start with that. And so, Tom, do you want me to unpack what that means, or do you have a question around that before I kind of pivot in?
Yeah, it's kind of some of the, I mean, there's like so many questions because,
Oh yeah,
I'm starting to learn things again now with the captive, as you're talking, because, I know we had with David, we had a property segment where he
I work
talked
with
about
David
the
a lot.
layers.
Yeah,
Yeah, the towers and the layers and all that. So trying to explain that, now we have a great video on it, right? And then, so what you're talking about here, because you do have the property captives, but I think more gearing on the more popular captives are the general liability, workers' comp, and auto liability.
sure.
And you talked about single parent, you talked about group captive, a couple different things. Let's go to let's say so you have ABC company, right? How do you like what qualifies somebody as a good candidate? We'll start there. What's a good candidate for a captive? And we'll disregard the property side of it now. We'll go,
Yep.
who's a good candidate?
The other thing about good candidates, we start looking at it. First starts with the size of the organization. So how much premium are we paying? Minimum, so group captives, they start at a minimum. Some of them will go down to 150,000. 250 is probably a better field depending on their work. Have we done them in that 150 range? Absolutely. Is that as common? No, right? So minimum premium I think is interesting because I think there's it's being fixed, but there's this misconception around that captives are only for the large of the large, or they're only for organizations that are $1 million in premium or up, or publicly traded entities or something else. One of the most common captive structures, guys, is group captives. There are literally hundreds of group captives that exist for all different types of industry, with different retention levels, with different structures. Our job is actually to find the right solution that fits an insured. But tell them that they start at about 150, 200,000. They go up from there. When you start getting into the call it 7-figure spend, combined spend, you start looking at more cell captives or some hybrid structures. And then from there, it's kind of whatever you want. We have some members that are in group captives that are spending a couple $1 million, $2.5 million, because it fits there. The question is, hey, what options become available and when they become available. But so we look at the premium size first, and then we start thinking about the risk management end of it, and we start thinking about how involved they want to be or uninvolved they want to be in owning an insurance company. We think a lot about from an alignment side, their acquisition history. So are they looking to acquire? Are they looking to be acquired? Because captives are especially on the P&C side, these are a long-term play. And you have to think about that in long term. So a lot of times they're privately held, well established. They have a good history of controlling risk within the organization. They have right safety practices that are in place to make them profitable within their own insurance company. And then it gets into the premium side. So I think just from like a high level, that's probably where it starts, Tom. Mm-hmm. And then we start doing the math around it. And so when I said the math, the rule of thumb that I will use is the 60-40 rule. And so when you're thinking, I literally call it napkin math, right? Which is, hey, if you were sitting down at a restaurant with somebody and like, hey, give me a quick high level of how this might work. Well, 60-40. So have them, ask them what their premium number is. So capture that premium dollar in your mind, combine work comp, general liability, and auto. Capturing that dollar in your mind, apply this principle that we use when we talk about captives. It's called the 60-40 rule, the 60-40 principle. 60-40 rule states that 40% of that premium dollar goes to the cost of owning and operating an insurance company. So it pays for the fronting, the reinsurance, the claim settlement, captive management, licensing, audit, tax, all the costs associated with owning and operating that insurance company. And the other 60%, Tom, it exists in a loss fund to pay your claims, to pay their claims. So the question to ask is, hey, if I were to give you 60% of your insurance spend back every year to pay claims, over the last 4 or 5 years, would you have won that bet? Would 60% be enough? Would there be any money left? And that's how we evaluate it, because what's left out of that 60, they're able to keep. They're retaining that profitability. So if you have a guy who's spending, $1 million, 600,000 in a loss fund to pay claims, 60%. If they average $200,000 a year in claims, great. You're retaining $400,000 of the profitability within your insurance company. That's the reason that people will do this. If you want the elevator pitch of, hey, tell me more about captives, that's what you break out. You break out, hey, what's a captive? An insurance company, licensed, regulated. And then why do people do it? First reason that people will do that is the retention of the underwriting profit, so retaining of that underwriting profit. And you break out 60-40. That's the math of it. And then from there, you start talking about collateral and capital and alignment, and you start breaking out historical experience, all the things to round that out. But it really just starts with premium in versus dollars out. And is it profitable or not?
Yeah, that's an interesting, the 60-40. So I remember you talking about that in the past. And that's something when you're looking and you're talking to a business owner, like I said, I mean, you have to be careful on the premium size. So the larger the premium size, of course, the better off you are, and the more you can benefit from being in a captive. And so on a finite, when you say the captive is an insurance basically it's a issue ID cards, certificates. Um, is there on the back end, are they using insurance carrier paper on the back end of that? Is that how that works?
Yeah, yeah. The vast majority of the time, especially when we start talking about like group captives, but even most single parents or single cells, you got to remember these captives, how they're structured. They are unrated insurance companies. They don't carry an AM Best rating.
Right.
Matter of fact, most of the time, especially in a fronted arrangement, they're actually just they're a reinsurer of the front. So let's unpack that. So I said that back. Let me back up. Not all captives, but most captives, they have a requirement to be able to issue a policy, a certificate, something else, something that evidences coverage in a specific state. Whether they have insurance requirements, again, as a subcontractor, whether they need an auto liability filing in the state of whatever, Tennessee or Kentucky or wherever they're operating out of. They need somebody to issue a workers' compensation filing to the individual states in which they're operating. They have those contractual requirements to an organization. So then when we say fronting policy, what that means is that the captive, group captive or not, is going to the market and they're going to a specific carrier and they're saying, hey carrier, hey AIG, hey Travelers, hey Arch, hey Liberty, somebody else. And they're saying, hey, I need a policy. Okay. And that carrier is providing them typically a first dollar guaranteed cost policy. I mean, it has a small deductible on it, but it looks and feels just like their policy does today because it's being issued by that carrier. It's their license, it's their AM Best rating, it's their ISO forms that are within that. It's what keeps them compliant, so it keeps the insured compliant with all of their certificate and in contractual needs they be able to evidence coverage from. And so then what happens is that they've issued us a policy. We've said, hey, thank you, Tom. I need a policy. Thank you for giving me a policy. Now, I can evidence coverage. Certificates can go out. Right? It looks and feels to the outside world. It looks like that you're insured by that carrier. And then behind the scenes, there's just an agreement that says, hey, when a claim comes in, I'm going to take the first 350,000 of each and every claim, or 250,000 of each and every claim. So 0 to 250 is going to sit with the captive. Anything above that is either being reinsured away or it's being retained by whoever that fronting carrier is. And so again, this is where I said captives are while it's a form of self-insurance, it is not total self-insurance. You want to be able to retain some risk. Well, in this scenario, we're retaining that risk from that carrier. We want to retain some of it. And for that retained risk, we're going to retain 60% of the underwriting premium to pay that exposure. And then the rest of it goes to the carrier and to all the other expenses of owning and operating that insurance company. But group captives it's exactly how group captives are structured. You have a group of insureds coming together to share risk with each other. Some of these group captives might have 15 members in them, 10 members in them. Some of them have 500 members in them. Like they can be really, really broad. They can be really, really specific. There's a lot to kind of unpack with each one of them around various retentions and forms, and they all have different coverages, and there's levers to pull around all of that and how we evaluate group captives for specific insured. But that's exactly what they're doing, Tom. All of the members are coming together and they're saying, hey, carrier, we all need a work comp policy. We all need an auto policy. We all need a GL policy. The carrier is issuing that policy to the individual insureds. And then behind the scenes, the captive says, hey, thank you. We want to be able to take on 350, 400,000 per claim as a group. And then above that, carrier, you take it. So as a group, they've just retained $400,000 worth of risk. They get a portion of their premium ceded down to the captive for the risk that the captive is taking. Captive pays claims based on those dollars and then allocates them to the individual members.
Yeah, and that's good because you get worried about when you start talking about self-insurance, even on the benefit side, the backstops. Where does it stop, right?
Yeah.
And that's because you used the $1 million situation. $1 million, 600,000, the 60% goes into the claims fund. You don't want to have a $600,000 claim just blow through it. Next thing you know, you have no money left just from one claim. So that's good. The way it's structured is that there is a backstop per claim, but then overall, there's still a maximum liability as well.
Correct. Yep. So there is a to your point, right? There's a specific stopping point, so per claim,
Yeah.
and then there is an aggregate stopping point, which is, hey, if we have a bunch of little losses that total up to a certain amount, where does the bleeding stop? And so there is a maximum out of pocket that gets allocated by member by policy year. It says, hey, if your loss is at a certain point, kind of in total, you're done. Member's finished. If it's a specific claim and it starts to build, there's a stopping point to that where it says, hey, go back to what I said. You want to assume the predictable and transfer the catastrophic. That's what we're talking about. We want to assume what's predictable. What's most predictable? First 100,000 of those claims, there's a lot of predictability in it. The bigger the claim, the less predictable it gets, right? Take that all the way out as you get into like excess layers. Man, it becomes very unpredictable, which is why you're seeing these nuclear verdicts and these thermonuclear verdicts that are, tens of millions of dollars. Those are being done by jury awards, right? Those are not, and so there's a lot of instability or it's just not predictable within that. So you don't want to retain all of that risk. You want to retain what's predictable. More importantly, though, Tom, I always tell people this: what kills you in these captives, it is not the $1 million claim. It is not severity that kills you in these captives. What kills you is frequency. It's the $50,000, $75,000 claim that just eats away and erodes that loss fund. That's what breaks these things. When we start thinking about the aggregate, it's not the $1 million because you're buying reinsurance for a big chunk of that. What kills you in these things is frequency. And that's where I think that it clicks for a lot of folks, brokers too, where they say, hey, we don't own an insurance company, we don't own a captive. But they had the same fear that you had, which is what happens, I get this question all the time, what happens if there's $1 million claim? Yeah, fair. It's a fair question because everybody thinks about these 7-figure suits. You're buying reinsurance side, your umbrella and excess stand over top of this, just like it does today. It's still an insurance product. This is meant to respond. It is meant to, but it's meant to insulate you. And I was push this back from like a premium side because that is the downside of these captives. Right? The downside is, look, we love the idea of being able to retain 60% of our premium. We love the idea of being able to retain the profitability. We would be disingenuous or dishonest if we didn't talk about the downside of this. The downside is I have, again, let's say it's an account that's spending $200,000. You got 120 in your loss fund to pay claims. Let's say if you have $130,000 in losses. Is there an accessible product? Means that you're going to write a check for $10,000 to bring that thing solvent. That's the downside. The downside is that you can pay more in these captives. In any scenario, you again are participating in the risk, good or bad. And so understanding that, yes, there is a tremendous upside, a lot of predictability, a lot of stability. Man, there is a downside to this. And this is where we have to understand the risk tolerance of that organization. Make sure they understand what they're getting involved in.
Yeah, that's an interesting with so let's say, well, we'll go back to when you're talking about risk management and your claims history, because especially in a group captive, you've got, let's just say you have 25 members and one new company wants to join, right?
Mm-hmm.
They think they're a great risk, but of course, it's going to be vetted out. What's your loss history? What's your risk management? What are your safety practices? Because in the event in that group captive, one company comes in, they can blow it for everyone else. Is that correct or no?
Yeah. But I think below it could be, it depends on the size of the group. I think below it is probably a little harsher of a term, but can that member cause risk sharing amongst all of the other members? Yes.
Yeah.
That is what the definition of a group captive is. You have a group of insureds coming together to share risk with each other, which means that I'm going to take on some of my risk. Tom, you're going to take on some of my risk if it gets to a certain point. Do I need to be good? Yes. I have a responsibility to the other members. So the other members have responsibilities to me as well, right? To each other. So there is this common accountability that exists within group captives. Yeah. Where you do want the best of the best. You want to control who you let into that group. You want to make sure they understand and evaluate how they're managing risk. Again, it's still an insurance product. Like it is meant to respond. Like it is never sold or it never should be sold as, hey, this is a way for us not to, like that we're going to be insulated from each other. No, the group by structure has ways to kind of insulate the members from group sharing, but you are absolutely still exposed to other parties. So yes, risk management, understanding risk tolerance, understanding the financial performance of that organization. It's important for the other members, certainly.
Yeah. Yeah, I guess saying blow it for the rest is a little harsh, but
Cool.
it does affect what they get back. And
Yeah,
that's a good
certainly.
yeah, and that's a good question. So, let's say whether you're a single parent, a group captive, you get to the end of the year and there's positive money still left over. How does that like the captive doesn't just issue a check right away? How does that work? How does that work on the back
Oh,
end to get that money back?
yeah. So a good rule of thumb, right, when we start thinking about this, is that it's going to take 4 to 6 years before these captives start kicking off cash, and there's distributions that are eligible. When I say that, we're talking about 3 years post the first term ending is um, is typically when you'll start seeing distributions. So in year four, you'll probably see a partial distribution from year one. In year five, you'll see a second partial from year one, probably your first partial from year two. In year six, we'll look to close out that underwriting year in year one. When I say close it out, it just means that we're done, we're finished with that year as a group or a single parent. We've novated, we've done something to end out the year in case another claim comes in or if something deteriorates or something changes within the operation. We're no longer exposed to that. So we can, as a group, we can close that year out. And so in that sixth year, we're going to close out year one. You get your second partial from year two, your first partial from year three. So kind of year three, four, and five, four, five, six, it starts to build. But the question that always gets asked is, well, look, why does it take that long to get cash out of this thing? Okay. Remember, what's a captive? Tom, what's a captive? It's come on, it's an insurance company, right?
Right.
It's an
Insurance
insurance
company.
company.
Yep.
So we have the same rules and regulations associated with owning and operating an insurance company. These insurance companies, they have to account for the known events. So, hey, we knew about this loss. We have to we have to close out those losses. We have to count our reserving within that. And then most importantly, we have to account for the IBNR. Well, the IBNR, we love our acronyms in the insurance business, but IBNR stands for incurred but not reported. So it's an actuarial number that says, hey, we don't know about this claim yet, or we don't know if this is going to develop yet. We have to have an accounting function to account for that potential risk 2, 3, 4 years down the road. So we have to close out all of those things before we can get some actuarial credibility or some certainty to how we can close out our underwriting years. There's just some certainty to the financial. Because if you issued a check in year two, but then you had a claim come up, what's the group going to do? Hey, Tom, remember that check we gave you? We're going to need a little bit of that back. We're not going to do that. You can't do that inside these. Like it just from a regulatory side, you can't do that. You become insolvent, and you can't have receivables or potential receivables from the members themselves. That doesn't
Right.
that doesn't fit. So it's going to take several years, 4 to 6, before this thing starts kicking off cash. And Tom, here's the other way to think about it. I'm going to ask you a question. Tom, have you ever had a workers' compensation claim? Or maybe a better question. Tom, how long does it take to close out a workers' compensation claim in your experience?
Oh, we've had some on average, minimum a year on,
Minimum.
I mean, the simple workers' comp claims, you get stitches. Okay, that's done, right? You're done
Yep.
in a month, whatever. But you start getting into the little more, we call them the hairier workers' comp claims,
Yep.
general liability claims. I mean, minimum a year. I mean, we have some that drag on for 3, 4 years, and they're still sitting there
Yep.
because I mean, once you start getting attorneys involved, it's a serious situation. You have surgeries, you have all that starting to add into this, and we call it creating a mess on the claim
Mm-hmm.
situation.
Yeah.
And then it blows up because now you have one side saying, okay, it's worth $100,000. You have the other side saying, no, I want $1 million. So now you have this whole thing where they're going to start going back and forth, back and forth, back and forth.
Yeah.
I mean, it can go on. Like I said, we had one that went on for 6 years.
Yes,
And,
which is which is also when we start thinking about this is like, all right, now how long does it take to close out a liability claim that has some teeth to it?
yeah, same thing.
Same thing. General liability, same thing.
Yeah.
We're accounting we're accounting for this IBNR. We're accounting for this potential liability as we work through it. And remember, we're an insurance company. Like that's why we started this way, because I need you to reference back to that. Like, oh, and can travelers do this? Can Zurich do this? And that's where we start thinking about, hey, are we allowed to do this inside of our captive?
Mhm.
Our insurance company, there are guardrails to that, very much on purpose, right? So,
Right. Yeah, and it's like I said, you kind of look at um, from the insurance perspective. Like I said, they automatically assume, hey, I'm paying this, I should be able to do this. But a captive is a great idea. You have other things you can go with retro plans with the higher deductibles and playing around with all that.
yeah,
But for those that really want to get involved in the weeds on this, I mean, a captive is a great option. We have how many?
yeah.
I mean, how many people do you put into captives on average per year?
Oh, I mean, probably 15 to 20, right? Different organizations every year have
Yeah,
for, and some of those are really, really large organizations. Some of those are, are smaller, like I said, group captive placements. It's always interesting to me though, is that a lot of times the sales cycle can be really, really long. And so, I mean, there's one that I think that we'll put in here in the next 4 or 5 days that I'm not kidding, we've worked on with this insured for 3 years.
yeah.
Just fine. It gets, but I'm not kidding when I say that. It was 3 years. We've gone through 3 renewal cycles because he was fixing his risk management. His experience was improving. His premiums were going up, but the captive's funding was still a little bit high. Well, it crossed, right? It's where it's like the standard market was going like this, and the captive leveled off. And when it leveled off, now we're in a good spot. But I tell producers this often, and I think this is where I got to kind of put on my teaching hat, at least my experience hat, and Tom, I would love your feedback on this. Is that insureds are looking for something different? They're looking for something different, and when I say that, is that for many years, and these carriers, and rightfully so, by the way, what I'm getting ready to say, they are pushing these various risk management initiatives onto their insureds,
Mhm.
whether it's standardizing some contracting language or cameras, forward-facing cameras now, and side cameras on the backside, or the geofencing when it came out, various telematics, and they're pushing all these standards, and they're doing that at a cost. There's a cost to the insured. Well, the insured is looking at this and saying, "Yeah, we're going to do this," and they're doing it in the hopes of getting a flat renewal.
Yep.
Are they getting flat renewals? Generally, no, they're not. It's like that market. It's continued to harden. That's why they're looking for something different. And if all we're doing inside organizations saying, "Hey, we're gonna go to the market. We're gonna do everything we can. We're gonna find other options," right? They're looking for something different that is not just we're going to switch carriers every 2 years. They're looking for predictability. They're looking for stability within their program.
Mhm.
Captive sometimes is really the only option to be able to do that, because that experience is based on that premium, excuse me, is based on their experience and their exposure. They're insulating themselves from kind of the outside market, the outside noise. And so they want some predictability. They want some stability within their program. And these captives are very, very predictable, because you know what the expenses are. You know, if you had a good year, what should happen to your premiums? They should go down. We're flattening them out, right?
Yep.
At least flattening them out from a rate perspective. Because again, an actuary is looking at that business and they're saying, how much money do we need to set aside for the payment of claims based on time, your business, where you're operating, how you're operating, what your exposures are. The flip side, that's also true though. But I mean, if you have really bad years, your averages are going up, so your premiums are going up. It's not rocket science,
Right.
right? It's simply just being predictable with what's here. And that's the difference. They're looking for something that is that is different. And so, like, why I say it's a 3-year term sometimes, not always like that, sometimes, is that we want to work with them from a risk management side. Let's get their risk management house in order. Let's make sure that this is right. Because the only way that that captive is profitable is if their risk management house is right. If they're profitable as an organization, they're controlling risk and claims within their operation. And so that's why I said it's a reward for organizations that manage risk well. I really mean that. If you fail to control risk inside a captive, if you don't have a good track record of controlling risk, and don't do this. It's just going to make things worse. You're not going to find predictability. You're not going to find stability. There's not going to be underwriting profit. There's no investment income. All the benefits that we talk about, they don't exist. So then what is our responsibility as brokers then? How much is your responsibility? Get their risk management house in order and give them something to shoot for. Because at the end of that kind of risk management yellow brick road, there's always some form of alternative risk financing. High deductible, retro, captive, something else they can do. You'll hear me say this a lot, man. What we're trying to figure out is for this insured, man, are you lucky or good? Are they lucky or good?
Right. I was just going to say there's a point there because you will have insurers that don't have the proper risk management. They don't have the safety committee. They don't have the safety teams, but very lucky. Been very lucky to not have claims. And so, you know, you kind of look at that. And I know even from, and I've heard so many underwriters say, look, they'll ask all the questions when you're marketing the account. What do they have for safety? What do they have for risk management? And then they have no claims. Well, I've heard someone say, well, under this scenario, I'm still not 100% sold because they're not trying to prevent. They're just being lucky. And so that claim is around the corner, is what a lot of them look at.
I don't think that's inaccurate, Tom. I mean, again,
Oh,
we have to demonstrate to group captives, to groups themselves, we have to demonstrate to underwriters and reinsurers, fronting carriers,
yeah,
that's that point. Man, are you lucky or good? Do you have a good track record? Do you have a good loss experience? Who's been lucky? Or are you doing the things necessary to actually control risk?
yeah,
Again, it is not the expectation that they are claims free. It's not that. It's about being predictable within their own loss experience.
uh,
And
well,
that's what we're after.
yeah. I mean, I've had underwriters say that they're doing nothing for prevention in the future. So
Yeah.
we're a little leery about giving them that ultra discount because, you know, they just
Mm-hmm.
feel like something's going to happen.
Yeah. And unfortunately, sometimes it does happen.
Yeah.
But the other side of this is true too, is they could be doing everything right,
And it still
and
happens.
something can still happen.
It still
And
happens, right?
and yes, and the captive will do what it's designed to do, which is take on some risk and transfer some risk.
Yep.
Right? And then what's nice about this is that it actually flattens out
Yeah.
because how an actuary is going to look at that most of the time is they're going to look at this and say, hey, what's the likelihood that this claim again? So when we start thinking about like how do we cap large losses to find some predictability in that premium pricing, everything's based on an average of 5 or 6 years. So you're going to blend that out over anyway. But then what happens if it's kind of a fluky accident? Like sincerely fluky, not, hey, you just hit somebody. Well, I mean, you could hit somebody tomorrow. It could happen again tomorrow. Someone had a really strange scenario. Yeah. I mean, it's about the predictability side of this that I think is important.
Right. And we've been going on for almost an hour now already. See, like you just start rolling in these things.
Oh man, yeah.
Yeah, if we start rolling in these, I mean, and it's interesting because we've only touched the surface of this, you know. I mean, we've gave not probably at 35,000. We probably came down to about a 25 to $20,000 or 20,000 foot level of information. And it's just, you know, like you said, you mentioned it in there. Insureds are looking for something different. They're looking for something, especially those that are good insureds from an insurance company perspective. You
Yep.
know, everyone's going to have some claims here and there. You know, eventually you're going to have your manufacturing facility, someone's going to get a finger stuck in something, they're going to slip on something, they're going to pull it back, you know, hurt their knee. Contractor, same thing, climbing a ladder, come off, you fall, whatever it is. You're going to have claims no matter what. You can have the best safety, you can have the best risk management practices, and it still happens. I have customers that have, from top down, I don't know anything else they can do to be on the prevention side, and then something still happens. But when you're looking at the captive perspective, like I said, they're all looking for something different. And in order, when you qualify for a captive, I mean, it's a long-term play. Like you said, you've been working on one for 3 years because you could have that. They could be halfway there on the risk management, halfway there on the safety side of it. But you just want to get that all tuned in, dialed in. And then for them to also, like I said, the education side of it is to understand, to be able to understand exactly what are the benefits and what's the downside? Because there is a downside. Every time there's a benefit to some, there's always a downside. Yeah, it's always back and forth. And, I think from a captive perspective, it's just something else. It's another thing to have. And when you have, and I'll go back to talking about the OneDigital way, none of us are experts in everything. We're experts in our own field. I'm on the commercial insurance side, and I know about captives enough to be dangerous. And that's why the OneDigital way is we hire experts in every field so that we can go out to customers. And now, when we were Crum Halstead locally, yeah, we did great. Local basis, we're local brokers. We have access to 100 and some different insurance carriers. Now we're with OneDigital. We have access to 400 some insurance carriers, but we also have access to experts like you, Aaron, where you go to a customer where in the past you can say, hey, yeah, I know about captives. I have a local, captive practice here. We use them just like an insurance carrier, and we can, market it out to them as well. But to have somebody internally that knows what they're doing, and obviously it's obvious from the award you got that you do know what you're doing, and to just be a consultant to our customers and say, look, Tom came to me and said, you're all looking for a different idea, a different way of doing things. We don't know if the captive is the best route for you to take, but we do represent X number of group captives. We can create single parent captives, which is what just one customer has their own captive, which that's a whole different thing on how to qualify for that. But to be able to do that, we have our wealth management team, we have our 401k, we have PEO, we have our human resource consulting. I mean, all the way on down the line, private equity consulting, M&A consulting. To be able to go out now and to say, hey, Mr. Employer, I would love to work with you. And here I hear what you're saying, that you're getting very frustrated with dealing with insurance companies. But we do have different ideas and some that may be able to help you. It's a long-term play. It's nothing you want to jump into right away without knowing what's going on. But we now have another option here. It's called the captive insurance concept.
Yeah, and look, I mean, I think Tom, there's a few things to unpack there. One, it's um, so oftentimes it's actually always interesting to me. It's very common for insureds to go into these structures off of their traditional renewal cycle. Start with that because they can kind of go in anytime. So long as we're addressing short rates or minimum earns or anything like that, they can kind of go in anytime. So it's actually very common that we have insureds that are doing this off of cycle, which is helpful because they can kind of get through their insurance renewal, get their certificates out, do everything they need to do to just continue to operating as an organization. Then they can kind of devote their time around this, which I think is important because that allows kind of their full attention. There's not an arbitrary, hey, we got to have it done by this. No, don't be wrong. We have plenty that are very renewal date specific, but there's just as many that we moving off cycle. Something else that you had talked about though around kind of the OneDigital way. You got to remember, I started with OneDigital right when developed this practice, right when we got into the property and casualty business as a company, as an organization. So it was part of that. It was part of that HM Risk acquisition in St. Louis, which is great. And so we've been able to kind of build this practice right alongside the holistic property and casualty vertical within OneDigital. So I get to work with all these various offices around this idea, but we've been able to create the practice kind of in our own image, which has been really neat. And we've been able to kind of push and sort of challenge our teams internally about how we think about this. Because so we've built this practice very much on purpose, by the way, through the lens of independence. So we are very independent in this. From a property and casualty side, guys, when I look at this, our job isn't to sell them a captive. Our job isn't to is to push them down this road. It's to give them the options that best align. Tom, you said something, man. There are hundreds of group captives that exist. Hundreds. There are dozens of administrators, right, or captive managers that are out there that have very unique, heterogeneous or homogeneous or different industry. There are very unique captive offerings, group captive offerings especially. There are dozens of captive managers. There are hybrid structures. There are cell structures. There's various facilities that are out there that we can kind of tap into. But when I say independent to this, guys, I really mean it. I don't own the captive. We don't own the captive. We don't own the captive manager. We don't own the facility that it's sitting in. We don't own the fronting or the reinsurer. We don't own the paper. We don't own anything. That allows us to bring in the best solutions that fit that insured. Different captive managers, different administrators, different domiciles, different fronting and reinsurance partners, different third-party carrier claims administrators, right? Various pieces from a capital perspective, right, or capital partners or banking perspective. There's pieces to this. But again, we talk a lot about alignment, but very much on purpose. We've created this captive practice to be agnostic to the structure and the design, so we can just deliver the best results for our insurance. We don't make any more or any less depending on where we're taking it to. It becomes very, very transparent. But what's unique about that, when I go into an insured and I say, hey, yes, you've heard about captives from this captive manager or this administrator. Have you ever thought about this? Or, hey, actually, you're private equity backed. Actually, maybe this is probably a better fit because we're managing collateral in a different way. They've never heard that on this side. Why? Either they don't know about it, or they don't own it, or they've got a point, like it's the easy button. Our job is to really understand the entire landscape. And then Tom, being on the broker side of it, but we work together to ultimately execute that structure in conjunction with your insurer. I just work right alongside our broker teams. And then we do all of this internal work, all this education. We do it all internally. So when I say that, like, I will give them the captive one-on-one. I will walk them through a group captive, a single parent structure, whatever we want to do. We will, from an indication side, we will put out an indication to paint a picture around premium and collateral and capital, pro forma together, historical experience, the whole thing, before we ever even take it to the market. And that's important because they get to be educated through the lens of independence, not just, hey, here's a solution. We're not giving you the solution first and working towards risk management. We're starting with risk management. We're starting with alignment. And then we provide the options that best fit that. And that's why it's a little different. This practice is set up a little differently than maybe how other organizations are doing it. Yeah, it's just about options. And that also actually creates, when we think about some of those options, it actually also creates opportunities with our various captive managers and our various partners with whom we work, our underwriters, is that typically because we're doing so much of this work on the front end and we're spending the time with the insured and we're getting good data, right? When they get a submission, it's a nice, full, tight, complete submission. But they also know that by the time that they get it, it's kind of done. They have a general understanding of, hey, what's this going to look like? And usually, Tom, within a few percentage points either direction, pretty close. We've done those enough. They're not findable. We never tell them it is. But from an educational side, here's the premium, here's the capital, here's the collateral. Does this fit with you insured? Do you like this? Before we ever, and sometimes we have those discussions, Tom, sincerely, and we'll talk about collateral, because collateral, look, when we start thinking about the economics of this, where does it get derailed a little bit? Collateral is generally speaking, is probably a good, again, napkin math, 100% of the premium. If it's a group, they'll take a third of that every year. So first third is 1/3 is due in year one, the second third in year two, the final third is due in year three. ish. So if you got a guy that's spending 500 grand, he needs to be ready to spend about 490,000 in collateral. Do they have that? Like, are you comfortable with that? Do they have that type of borrowing capacity? What does that? And then if we do it, if they're in like the construction space, what's the impact to like bonding capacity and borrowing capacity of an organization? And so that's where it talks about alignment a lot. We try to work through that, but it's it when we work with our broker partner, or not our broker partner, sure, our reinsurance and underwriting partners, they know by the time they get it, it's pretty well done. It's in a really good spot. Um, I bet our hit ratio, I've never actually sat down and done that, but I bet our submit to quote ratio, 80%. I mean, it's probably really high. I mean, I guess. Because it just, and we also know what their criteria is. We know what they're looking for. We know what their underwriting is. We've done enough of these that we can kind of figure it out.
All right.
So,
All
anyway,
right. Well, kind of sum it all up. If anyone's out there looking, insurance, the parameters here. You're kind of looking at someone, your general liability, your workers' compensation, your auto liability. Those premiums, you're suggesting more in the 200 to 250 minimum range. If you're paying in that, you have a great loss ratio, risk management strategies, and you're just looking for something new or a different idea on how to insure your operations. Reach out to me. We'll get Aaron involved. You're ready to learn. He's an expert. The 40 under 40, you don't get that when you're not an expert. I'm going to put it that way. When you're not an expert, you don't get awards like that. So we have the team here. Um, Reach out to us. Reach out to me. We'll get it all set up. Just something to look at, even if you're just interested in seeing what it looks like. Let us know. Doesn't hurt anything. There's no cost to take a look at it. You're going to look at it, evaluation. Do you fit for a captive? Do you not fit for a captive? We don't know till we actually dig into it. We'd love to be there to help you.